Ever see a great options trade but don't have enough capital to take it? Well, today I'll show you a strategy that turns a $9,600 covered call trade into a $2,200 diagonal. Essentially the same upside, but at a quarter of the cost. Let me show you how this works. Back on April 4th, PSX, that's Phillips 66, had dropped fast, closing at 98.81. The RSI was down at 21, which is super oversold. Now, a classic covered call would have worked great here. Buy 100 shares, sell a 120 strike call expiring in June, creating a covered call trade. That combo would have cost you $96.71. But what if you only had, say, $3,000? Well, here's the trade. Instead of buying 100 shares, buy a deep in the money March 2026 80 strike price call. Sell that same June 120 call that we did with the covered call, and that combination is called a diagonal spread, and it will only cost you $2,260. By June 20th, PSX had bounced to 124.78. In the covered call version, you're required to sell your shares at 120 and you profit $2,329 or 24% return. Nice, but only if you had 10 grand. But with the diagonal, here's what happened. You sell the now expensive long call for $46.45. You buy back the short call for $470. You subtract your original $2,260 investment, and your net profit is $1,915. That's less absolute profit in dollars, sure, but only on a quarter of the capital. That's an 84% return. So yeah, you gave up a few hundred in profit, but without $10,000, that covered call trade wasn't even possible for you. This diagonal strategy lets you stay in the game and more than triple the return. That's why smart traders learn how to make their capital stretch through using deep in the money call options.